Guys, welcome back to the channel. So in this video, we're going to look at velocity banking versus itself. So basically we will look at two examples. This is going to be a comparison on the amount saved in interest using the exact same income, same expenses, and same cash flow. So let's get into the video.
Let's create a budget. Let's get out of debt. Let's build wealth.
Okay guys, so what we're going to be doing is we're going to be comparing two examples here of debt. So we have a total of $20,000 in debt, and the only difference is it's going to be the due dates. So we'll have the miscellaneous expense due on the 1st, the debt due on the 7th, 14th, 21st, miscellaneous due on the 10th and on the 20th. And then in the second example, everything's the same: debt, payments, balance, APRs, everything's the same. The difference is the first expense will be due on the 24th, 7th, 14th, 21st, 10th, and the 28th. So we will start with this first example. So we're going to use a personal line of credit. So we'll have a $20,000 personal line of credit. Interest rate, we're going to, for example, we're going to be using 5%. Doesn't really matter what we put there, we'll use 5%. So we are going to take the whole $20,000 out of the line of credit, and that will pay off this debt. So there will be no payments on the debt, as we would transfer it all and pay it off. So that's going to leave us with a cash flow of $250.25, and we will have $1250.25 coming out on the 1st every month, $699.50 coming out on the 10th every month, and $800 coming out on the 20th every month. So in scenario 1, the income of $5,000 will go into the line of credit. On the 1st of the month, $1250.25 will be taken out. On the 10th of the month, we will have $699.50 taken out, and on the 20th of the month, we will have $800 taken out. So this is a comparison. This is, for example, the date at which the expenses will be due. So this is when they will be coming out of the account. And you can see so that's just what happens with velocity banking. As your income goes into the account, it drops the balance, but as you take it out, it brings it back up. So it'll drop, go back up, drop, go back up, drop, go back up until there's no debt left. So same thing in February. Payment income will go into the line of credit. We'll have our withdrawals of $1250, $699, $800. March, income in, expenses will come out. April, income will go in, expenses will come out. May, income in, expenses out. June, July. Now in August, the income, we have an income of $5,000. We can't stick the whole $5,000 into the line of credit. So the most we can put in here is $4,554.07. Now we had $5,000 income. So if we take the $5,000 and we subtract $4,554.07, we have $445.93 left. So since we have this in the checking account, when we go to make that withdrawal, we need to withdraw $1250.25 on the 1st. $1250. We will only withdraw $804.32. So this will be 804.32. So that amount withdrawn plus what you already have in your checking account will equal the $1250.25. So on the 10th, we'll have coming out $699.5, and then on the 20th we will have coming out the $800. Okay, so September, the income $310.67 will go in. We take our 5,000 income, subtract $310.67. In our checking account, we'll have $2,689.33. On the first, we won't withdraw from the line of credit the $12.50.25. It'll just come straight out of our checking account. We'll have $14.39 left. On the 10th, we won't withdraw the $699.50. We'll just pay for it out of the checking account. And then on the 20th, we need $800. So we will need to withdraw $60.42. So on the 20th, $60.42 will come out. So if we go to October, right, we'll pay payment of $60.51. We have our income of $5,000. We subtract the $60.51. Leaves us with $4,939. We can see that our expenses for this month is a total of $2,749.75. So if we subtract that, the line of credit is paid off at this point, but we need to compare what's left, the difference. So this will subtract the expenses for October, $2,749.75. We end up with $2,189.74 left in our checking account. So in this first example, took 10 months. We have $2,189.75 left in the checking account. So looking at scenario 2, we'll do the same thing. The only difference was the date. So these two people, they make the exact same money, exact same expenses, exact same cash flow. All of their bills, expense, everything is the same APRs, same balances, everything. The only difference was the day in which their bills were due. So looking at scenario 2, we'll have the same income going in. The only difference is all the payments are the same as the dates. So on the 10th, we'll have $699.50 coming out. On the 24th, the $12.50.25 comes out, and on the 28th, we have the $800 coming out. So same scenarios, same thing, just switched up the dates. Okay, let's run through this one. So in February, income comes in, expenses come out. March, income in, expenses out. April, income in, expenses out. May, June, July, and just like in scenario 1, in August, the whole amount won't be able to come in here. So we can only put in $4,519.86. We take our income of $5,000. We subtract the $415.19.86. We have $480.14. On the 10th, we owe the $699.50. So on the 10th, only $219.36 will be taken out. That $219.36 plus the $480 we had in our account will make those expenses due on the 10th. So on the 10th, 219.36. On the 24th, we'll have bills again, 1250.25, and on the 28th, 800. Okay, so September we can put 227208. So if we look at our income, 5,000, we subtract the 270, 5,000 minus the 227, 2.08. That leaves us with 2,727.92. So on the 10th, we won't need to withdraw the 699.50. And then on the 24th, we won't need to withdraw the 1250.25. So on the 28th, we'll need to withdraw 2183. Go down to the 28th, 2183. So come October, we will put 2184. So we'll take our 5,000, we'll subtract the 2184, and the expenses 2749.75. We have a total of 2,228.41. So this one was also paid off month 10, 228.41 in the checking account. Okay, let's compare that with the other one. We had 2,189.75. So if we look back, okay, we'll take the 2228.41 and we'll subtract the 2189.75. So we have a difference of $36.88. Okay, so there you go, $36.88. So that's what velocity banking, understanding that how long you can keep the money sitting. This is the exact same scenario. Every single thing was the same except for the date, except for the time that the money had to come out of the account. So, it just basically depends on velocity banking. Comparing velocity banking to other methods such as debt snowball or debt avalanche, it comes down to numbers. But if you're just comparing it to itself, it's all about, there's one simple rule when it comes to really any kind of revolving line of credit, and that is how long can you keep the money in there before you have to take it back out. So I hope you enjoyed this, guys. As always, a thumbs up is greatly appreciated. Don't forget to subscribe if you haven't, and click the notification bell so you never miss a video. I'll see you guys in the next one.